A Social Security check can look like a simple monthly payment, but behind that payment are years of work, payroll taxes, earnings records, filing decisions, and rules that can affect how much money you actually have available in retirement. And as we move through 2026 toward 2027, there are some mistakes seniors absolutely should not ignore. The scary part is that you don't always notice these mistakes immediately. Sometimes the problem doesn't show up until months or even years later, when fixing it becomes much harder. So if Social Security is an important part of your retirement income, stay with me, because today we're going through 6 mistakes seniors should check before 2027, including mistakes involving your earnings record, claiming strategy, taxes, work income, and your personal information. And the last mistake is especially important because many retirees don't realize they're making it until it is already costing them money. Let's start with mistake number 1, assuming your Social Security earnings record is automatically perfect. Most people naturally assume that because they worked for decades and their employers reported their wages, the Social Security Administration must have every number exactly right. But your earnings record is extremely important because your retirement benefit is based on your earnings history. If an earnings year is missing or an amount is incorrect, that can potentially affect the calculation of your benefit. This is why one of the simplest things you can do before 2027 is log into your official Social Security account and review your earnings history. Don't just look at the total benefit estimate. Go through the individual years and look for anything that doesn't make sense. Imagine someone worked at the same company for 20 years, but 1 year of earnings is missing from their record. They might never notice because they aren't checking the details. Years later, when they begin receiving benefits, they may wonder why their payment isn't what they expected. This doesn't mean every discrepancy automatically results in a lower check, and it doesn't mean Social Security records are routinely wrong. The point is that you should verify your own record instead of assuming everything is correct. If you find an error, gather documents such as W-2s, tax records, pay statements, or other evidence that can help establish your earnings. The earlier you identify a potential problem, the better position you are in to address it. And here's something important. Don't wait until you're sitting in a Social Security office or preparing to retire to look at your record for the first time. Make reviewing your earnings history part of your regular retirement checkup. If you've already claimed Social Security, you can still review your information. If you haven't claimed yet, this is even more important because you're still planning around the benefit estimate shown to you. Your retirement income plan is only as good as the information you're using to build it. Now let's move to mistake number 2, claiming Social Security without understanding what the timing means for your monthly benefit. This is one of the biggest decisions a retiree can make, and unfortunately, some people treat it like a simple yes or no question. Am I eligible yet? But eligibility and optimal timing are 2 different things. You may be eligible to start receiving retirement benefits before your full retirement age, but claiming earlier generally means a lower monthly benefit than if you wait until full retirement age. On the other hand, delaying benefits can increase the monthly benefit for those who qualify for delayed retirement credits. The right decision depends on your individual circumstances, so the mistake isn't necessarily claiming early or claiming late. The mistake is making the decision without understanding the trade-off. Think about what happens when you choose a monthly benefit. You're not just deciding how much money you receive this year. You're potentially establishing a stream of income that can continue for the rest of your life. If you claim earlier and receive a smaller monthly amount, that decision can affect your future income. If you delay, you may receive larger monthly payments later, but you give up benefits you could have received during the waiting period. There is no universal answer that works for every senior. Your health, expected longevity, spouse's situation, other retirement savings, work plans, and immediate cash needs can all matter. This is why, before 2027, anyone who hasn't claimed Social Security yet should take a serious look at the numbers instead of simply following what a friend, neighbor, or family member did. Your neighbor might have claimed at 62 and been perfectly happy with that decision. Your situation may be completely different. Another person may have waited until 70 because they had other income available. Again, that doesn't automatically mean waiting is right for everyone. The important thing is to understand your own options before locking yourself into a decision. Now here's mistake number 3. Forgetting that Social Security can interact with other income. This catches many retirees by surprise because they think of Social Security as completely separate from their IRA, 401k, pension, investment income, or part-time job. But when you're planning your retirement finances, you need to look at the entire household income picture. Depending on your circumstances, some Social Security benefits may be subject to federal income tax. Other income can influence that calculation, which means a large withdrawal from a traditional retirement account could have consequences beyond simply receiving extra cash in your checking account. Let's say you need $20,000 for a major expense. You might think, I have $20,000 in my IRA, so I'll just withdraw it. But before doing that, You should understand what that withdrawal does to your taxable income and your broader retirement plan. Depending on your circumstances, the additional income could potentially increase your tax liability and may interact with other income-based programs or costs. This doesn't mean you should never withdraw money from your retirement account. You may absolutely need to. It means you should think about the tax consequences before you make a large withdrawal, rather than discovering them after the money is already gone. This is particularly important for seniors who have multiple income sources. Maybe you receive Social Security, a pension, interest from savings, dividends from investments, and withdrawals from a traditional IRA. Each source might look reasonable by itself, but when combined, they can create a very different tax picture. That's why retirement planning shouldn't be based only on your Social Security check. You need to understand how all of your income works together. And that brings us to mistake number 4, working while receiving Social Security without understanding the earnings rules that may apply before full retirement age. Retirement doesn't necessarily mean completely stopping work. Millions of older Americans continue working, right, whether that's full-time, part-time, consulting, seasonal work, or running a small business. And there's nothing wrong with earning additional income. In fact, for some seniors, working longer can be a very smart financial decision. But if you've started Social Security before reaching full retirement age, you need to understand how the earnings test works. The Social Security rules distinguish between people who are below full retirement age and those who have reached it. If you're receiving retirement benefits and earn more than the applicable annual limit before reaching full retirement age, Social Security may withhold some benefits under the earnings test. So once you reach full retirement age, different rules apply, and benefits withheld because of the earnings test can be taken into account when recalculating your benefit. The exact earnings limit can change, so don't rely on an old number you found online several years ago. The mistake is assuming that because you're already receiving Social Security, your employment income doesn't matter. If you're thinking about taking a new job, increasing your hours, starting a side business, or returning to work, check the current rules for your specific situation. You don't want to accidentally create a surprise because you assumed the rules were simpler than they actually are. Now let's talk about mistake number 5, ignoring scams and failing to protect your Social Security information. This might not sound like a benefit calculation mistake, but for seniors, protecting personal information is directly connected to protecting retirement money. Scammers know that Social Security is extremely important to older Americans, so they use fear and urgency to get people to act without thinking. You might receive a phone call claiming that your Social Security number has been suspended. You might get an email telling you that your benefits will stop unless you click a link. You might receive a text message asking you to verify your bank account. The message may even use official-looking logos and government language. But legitimate-looking communication doesn't automatically make it legitimate. Never give your Social Security number, banking information, passwords, or security codes to an unexpected caller simply because they claim to be from a government agency. If you're unsure, stop the conversation and independently contact the organization through an official phone number or website. Don't use the number provided by the suspicious caller, and be especially careful with anyone who demands immediate payment, gift cards, cryptocurrency, wire transfers, or unusual forms of payment to protect your Social Security benefits. Your Social Security payment is valuable, but your identity and banking information can be even more valuable to a criminal. Once scammers gain access to sensitive information, the damage can extend far beyond one monthly check. That's why cybersecurity should be treated as part of retirement planning in 2026. And finally, we come to mistake number 6, assuming your Social Security strategy never needs to be reviewed after you retire. This may be the most overlooked mistake of all. Many people make their Social Security decision once, start receiving payments, and then never think about the broader strategy again. But retirement doesn't stay exactly the same. Your expenses can change, your spouse's situation can change, your tax situation can change, your investments can change. You may start working again, you may stop working. Your healthcare costs can change, and your family situation can change. That doesn't mean you can simply change your Social Security benefit whenever you want. Some decisions are permanent or have strict rules attached to them, but it does mean you should regularly review your overall retirement income plan. Ask yourself, where is my money coming from? How much am I spending each month? Am I withdrawing too much from savings? Am I taking unnecessary tax risk? Do I understand my Social Security benefit? Are my records accurate? Am I protecting my account from scams? If you can answer those questions confidently, you're already in a much stronger position than someone who simply assumes everything will take care of itself. Before 2027 arrives, take a few hours to organize your retirement information. Review your Social Security earnings history, check your benefit details, understand your claiming decision, look at your other retirement income, and make sure your account and personal information are secure. You don't have to make a dramatic financial move just because a new year is approaching. Sometimes the smartest retirement decision is simply finding a mistake before it becomes expensive. And remember, the goal isn't to become an expert in every Social Security regulation. The goal is to know enough to recognize when something deserves your attention. If you don't understand a rule, verify it through the Social Security Administration or another reliable official source. If a decision could significantly affect your retirement income, consider getting advice from a qualified financial or tax professional who understands your individual circumstances. Your Social Security benefit may be one of the most dependable sources of income you have in retirement. Protecting it isn't about chasing every possible dollar or making risky financial moves. It's about avoiding preventable mistakes, understanding the rules, and making informed decisions. So before 2027, don't just ask yourself, how much is my Social Security check? Ask a more important question. Am I doing everything I can to make sure I understand and protect the income I've earned? Because after decades of working and paying into the system, your retirement income deserves your attention.